Hi there. In this video, we will continue our discussion talking about the intercompany transaction between the parent and the subsidiary. And just to give you a quick overview of what I discussed in the previous video, that we said the intercompany transaction could include a transaction about inventory or fixed assets or a loan between the parent and the subsidiary. And in this chapter, we say the parent can make sales to the subsidiary, and we call it downstream sale. And the subsidiary can make also sales to the parent, and we call it upstream sale. The issue will happen if one sale goes from the parent to the subsidiary and vice versa, but it wasn't sold to the outside customer at the end of the year. In this situation, we have to generate unrealized gain, and we put it in the inventory account. But for the downstream sale, all the unrealized gain will go to the parent company. But for the upstream sale, all the unrealized gain will be divided between the parent and the subsidiary. And the issue is that for the previous examples, which I discussed it in my previous lecture, that the upstream or downstream sales happened one time at the end of the year. But in reality, it could happen at 1 year, and it can be carried forward to the following year, which I will discuss it in this example, where we will see some unrealized gain came from last year, and there is another unrealized gain that had been generated by the end of this year. Before we go through the example, if any unrealized gain comes from last year to this year, it will be added to the net income. But for the one that happens at the end of the year, it will be subtracted from the net income. So with this in mind, let us go through the example together. So here you will see on 2015, there is a transaction happen between the parent company by acquiring 70% from the subsidiary company. And the parent paid $301,700. On the same day of the acquisition, the NCI had a fair value of $129,000. And the book value of the net assets for the subsidiary company was $395,000. So it seems there is a difference between the fair value and the book value here, and the fair value is higher than the book value. And in this question, it asks us to allocate the difference, part of it to the increase in the land price, and on the other part, and the increase on the goodwill. So here we see I put some notes here that can help us to filter the information. So the difference between the fair value and the book value was $36,000. So how much we should give out of the 36 to the goodwill? We subtract 14,000 of the increase in land from the total increase, 36. And this will leave 22,000 for the goodwill. And now we need to take the 36,000 divided between the parent, that will take 70%, and the NCI, which will take 30%. And we need to do this in a separate journal entry that we will discuss it later. But this transaction has nothing to do with the downstream or upstream sale. It's a quick overview of what happened in the previous chapter. So this is the first one. In the second one, here some transaction happened in the previous year. So on January 1, we see some unrealized gain that came from 2018. But in the next paragraph, we'll see some unrealized gain that happened at the end of 2019. So here we see the parent company contained 38,000 of unrealized profit recorded by SED. What does it mean? This is upstream sale that happened from subsidiary to the parent last year. On the same day, Also, there is an unrealized intercompany profit that happened from the parent to subsidiary by 15,000, which we call it downstream sale. So here I put the information. We have upstream sale, 38. We have downstream sale, 15, which were coming from last year. And I will add it to my balances of net income. Why? Because they have been consumed this year. However, the unrealized gain from the upstream will be divided between the parent and the subsidiary, but the unrealized gain from the downstream will remain only for the parent. So for the total unrealized gain for the parent, you will see that we have the downstream amount plus the portion of the upstream. And the same thing for the upstream, I give another portion to the NCI. In the last paragraph here, we see that the language is slightly different, but easy, because it says the subsidiary sold inventory for 41,000 to the parent for 66. So the difference between the selling price 66 and the cost 41, this one is upstream sale. So here we see upstream sale that has unrealized gain of 25,000. In the same time, the parent company sold to the subsidiary company some goods for selling price of 104, but the cost price 62. From the sales amount of 104, 35,360 still remain. So what shall we do? First, we subtract the selling price minus cost price to get the net profit, 41,600. By getting the 41,600, I can use it to get the gross profit percentage. How? By dividing the gross profit over the sales amount. So 41 over 104, we get 40%. We multiply 40% by the remaining amount that was still unsold by the end of the year, 35,360, we get 14,144. Now, the total unrealized gain for the parent company will be the downstream sale plus the portion of the upstream sale. And here we get the other balance, which the remaining of the upstream sale, we give it to the subsidiary company. And I will explain this in the coming slide. But before we leave this point, we need to take the total amount of sales, 66 plus 104, and add them together to get the total amount of sales that will go into the closing entry later on. So with this in mind, we already analyzed the main data that we need to collect from the exercise, and now let us look at the trial balance. The difference between the previous example that I did in my lecture and this one, in the third exercise that I did in the previous video, it was talking about a balance sheet. But here we talk about trial balance. What is the difference between them? The difference will happen here in the retained earnings. The retained earnings that we get it in this exercise is the beginning balance, but the one we did it in the previous one will be the end. Now, let us do some calculation here to get our final amount of investment for the parent and the NCI. So we get the total common stock, 165, and this is the subsidiary balance, plus the retained earnings, 256, we get 421,000. We take this one and divide it 70% to the parent and 30% to the NCI. Then we go to the income statement. We don't have the income statement here, but we can easily calculate the income statement by getting the sales for 214 minus cost of goods sold and depreciation expense for 143 and 20,000. And this is all what we need to get to calculate the net income. So we get net income of 51,000. Then we divide the net income between the parent company and the subsidiary company. And the last calculation we need to do is for the dividends, where we take the $6,000 of the dividends and then divide it between the parent and the subsidiary. Based on the three calculations here of the equity, income, and dividends, we can get our balance for the parent and another one for the subsidiary. Sorry. Yep. So let me delete this one. So here we see the parent has a beginning balance of equity, 294,700, plus net income comes from the subsidiary, 35,700, minus dividends, 4,200. We get the ending balance of investment before we calculate the unrealized gain. For the NCI, we get the beginning balance of the investment, 126, plus the portion of the net income, minus the portion of the dividends. Then we go up here to get the upstream and downstream from last year and the upstream and downstream from this year. And here it shows that we have upstream 38, which I divided between the parent 70% and the subsidiary 30%. The downstream will go completely to the parent, and the upstream at the end of the year 25 will be divided between the parent and the subsidiary. And the downstream will be calculated for the parent. And then we add the beginning balance of investment plus upstream and downstream unrealized gain, minus upstream and downstream unrealized gain for the end of this year, will give us the investment account at the end of the year, which I will take it to the consolidating entry. And the same thing we do it here for the NCI. So now we can go ahead and do the calculation for the first consolidating entry, where we debit common stock 165, we take it from here, and the retained earnings 256, we take it from the trial balance. The income from subsidiary company 45,656, we get it here. And the portion for the NCI net income, we get it from this report here. So we have the net income here, 15,300, plus the unrealized gain upstream at the beginning of the year minus end of the year, we get the final net income for NCI. The dividends, 6,000, which were given, you can see it in the trial balance here. And then we have the investment here, the ending balance, and the NCI in the net assets, we get them. And this would be the first consolidating entry we need to do. The second one is the one for the land. So here we get the land and the goodwill from the first paragraph, we have it here. We were able to find that the land has 14,000 and the goodwill 22. And then we divide the increase between the parent and the subsidiary, which we will find it here. So we will find here debit land 14, debit goodwill, then credit investment and credit NCI. The last one is actually sales, and this would be the total amount of sales upstream and downstream from the prior year. And here we see debit sales 170, credit cost of goods sold, and the inventory 39,144. So yeah, this is from the prior year, and here let me go through the 170 again to clear it off. Yeah, you can see here it's 66, and here 104, sorry. So when you add 66 plus 104, we get 170. And here we have the 39,144, and this will be the total unrealized gain for both upstream and downstream. And the difference between them is the cost of goods sold. How can I close off the unrealized gain from prior year? We close it off here, where we debit the investment by the parent portion. If you remember, we had 38 that we divided between the subsidiary and parent, and this one for the downstream. We add both of them so we can get here the investment for the parent company. And then the remaining balance from the upstream will go to the NCI, and then we credit cost of goods sold. So in this journal, we credit the unrealized gain of this year. Here we credit the unrealized gain from prior year. And once we finish all the journal entries here, then we're ready to go to do the worksheet. As I said, here you can take your time, stop the video, try to take the exercise from Brightspace, complete the worksheet, and you just plug in the numbers here, and then you should be able to go. I hope you find these exercises are useful to show you how we make upstream and downstream either in 1 year or in 2 years back to back. Feel free to reach out, and I hope you do well in the assignment. Thank you. Bye-bye.